Thank you. Thank you. So Al is a seasoned veteran of the financial services industry with over 43 years of investment and wealth management experience. He started his career as an advisor to individuals and institutions to help them preserve, protect, and grow their wealth. And over the past 23 years, he has also consulted with investment firms, banks, and insurance companies around the world to help them improve the quality of their wealth and management business. Al is a registered fiduciary. That's always a hard word for me as a Cuban, and founded Townsend Financial Life Management as a partner and senior advisor, bringing his broad knowledge and experience to advise companies on their employer-sponsored retirement plans and help clients to plan for their retirement and manage their wealth. He works closely with his son, AJ, welcome AJ, to advise and guide clients to meet their financial goals and to protect their standard of living in every complex and constantly changing environment. And we cannot be more thrilled about having him kind of close out our session and speak to us about retirement planning. So you can take it from here, Al.
Laura, thank you. Arif, thank you as well. And for all of you, I appreciate you spending time this evening, and I'm hoping to bring some value based on some of the insights that I've gleaned over the, and it's rather embarrassing, Laura. Seriously, 43 years. I mean, it kind of aged me very quickly. By the way, can you tell there's a bit of a theme between AJ's office and my office? Oh, he just kind of moved it down a little bit. Yep, we do love the water and we do like to fish. So that's a big part of what we do. So let me start out by telling you a little bit of a story. And it's one where I had a client, or I had someone referred to me last week. It was a really nice couple, just a wonderful couple. They were in their mid-60s and they were just going into retirement. And as they were going into retirement, they felt that it would be good to get some advice. As a matter of fact, when they came into my office and they sat down, I could see that they had this look of concern on their face. And that concern was voiced within 5 minutes when they said, Al, here's what we're most concerned about. We're not sure we can survive through our years of retirement based on what we've saved to this point. So, and Arif, I'm going to steal from the title of this, and that is, when you get to retirement, the goal is not to survive, it's to thrive. And that's extremely important. And I think that made me to describe that is that, and this is based on a definition that I heard that I thought was just awesome, and it was that our goal in retirement is to have the financial ability to wake up any given morning and know that we have the ability to do whatever we want. So what I'm going to do over the next 20 minutes or whatever time, and by the way, it's a small group, so please, if there are questions that come up as we talk, feel free to just jump in there and ask them of me. Linda, by the way, I have an answer to a question that you asked last week, which is good. Chris, I expect that you're going to fact check some of the things I'm saying. And oh, by the way, I am not a broker. I'm an advisor. So there's a little bit of a difference there. But still, feel free to fact check me as we go. And what I'm going to do is I'm going to share my screen with you. And I want to walk through a bit of this presentation, because what I'd like to do is I'd like to be able to, what's that? Okay. There we go. Look at that. How's everybody see that?
Yeah, Al, leave it to Chris to show up this week. He should have been here when Kenny was going, right?
Yeah, but you'd have to see through that enthusiasm to be able to do the fact checking, all right? So what I'm going to conclude with are really some of the rules that I've been able to extract from the world of retirement planning that I hope is going to be very valuable to everybody as they look at where they are today and where they want to be when they retire. So a couple of the fundamentals. And yes, there are disclosures. There you go, Chris. Can you read that real quick? Are we good? All right, we got it.
It's a good thing this is recorded.
And it is. I know it's recorded. And by the way, yes, it did go through my compliance department, so it's okay.
I was going to say.
All right. If we go back years ago, there was a basic foundation for retirement planning, and it was what used to be called the three-legged stool. And that three-legged stool was made up of three components. And this is preparing for your retirement and the income that you would need during retirement. Of course, the first one was pensions. That was the first leg. And the second leg was Social Security. The third leg was savings. Well, if we look back, we've seen an awful lot of change over the last, well, certainly during the last 40 years I've been doing this, but especially over the last 30 to 20 years. And I want to go through some of these, starting with pensions. Quick show of hands, folks. How many of you are able to be part of are employed by a company that actually provides you a pension benefit? Chris, awesome. Arif, that's awesome. Arif, how the hell did you do that?
But it's my pension.
It's my
Oh,
old
your
pension.
It's my own. It's a set.
Okay.
It's my old pension.
There you go. Okay. Well, it's interesting that not many people, and when we ask this question, don't raise their hand because pensions are becoming a thing of the past, and there's a good reason for that. They're very expensive for companies to maintain. There's a lot of liability attached to them. And for those of you that have your own pension, if you're a sole proprietor, well, that's a different thing. But when you have a bunch of employees, take a look at what happened to, let's go back to GM when they filed for bankruptcy during the financial crisis. They literally had to go and renegotiate their pension benefits with their auto workers union so that they could get back on track. So pensions are pretty much going away, or they have been going away, and they've shifted to a thing called 401k plans or 403b if you happen to be in a nonprofit or a government type organization. And in there, what they've done is they've passed that responsibility of how much to save and what to invest that money into to meet your retirement goals to the employee. So they've shifted that responsibility off. And in essence, it's moved it away from the pension leg of the stool to the savings leg of the stool. And then, of course, there's Social Security. And if Kenny or Keith were on the phone, they'd be having a field day with this one because there's a lot of questions as to what's going to happen with Social Security going forward. Well, guess what, folks? Social Security is probably going to be there. The question is what is it going to look like in the future? I mean, if we go back a little ways and we can see how they've been chipping away at it, the bipartisan Budget Act that Obama signed into law started to chip away at the benefits because they knew that it was very, very expensive. So all of us that are on the phone and all of us are looking hopefully forward to the money that we put into Social Security and being able to help us when we get into retirement. The question is, will those benefits be there the way that they are today? I don't know the answer to it. I can tell you that last year was the first year that Social Security took in less money than it actually paid out. So what do we got? We got two legs of the stool. One may be broken, may not exist. The other one's a little bit wobbly. So what does that do? That puts a shift to the savings leg of the stool. And that's really the one that I'd like to spend time talking about tonight because it's one of the few things that we can actually control. As we look at our retirement, what it is that we want to have happen in retirement, this is really one of the things that we've got to look at. What are the variables? What are the things that we can actually adjust in order to make sure that we live right? Remember that couple that I told you about? The one thing we don't want to do is get to the point when we retire and we say, hey, can we survive? No, we want to be on that other side of it and say, we want to be able to thrive in retirement. So I want to talk about and start with what are the different options that are available to us for those savings. And there's three. There's the taxable options, and then I'm going to call these buckets. There's the taxable bucket, there's the tax deferred bucket, and there's the tax-free bucket. So bearing in mind that tonight is about financial literacy, I wanted to just briefly go through these in terms of how these can be used within a retirement savings plan. Taxable bucket. What's in there? These are the ones that we control. They're usually fairly liquid. These are brokerage accounts. We have mutual funds, ETFs, stocks, bonds, all those CDs. We might have real estate in this, but these are the ones that we have. We use our after-tax dollars and we invest in these. And then whatever earnings are realized in any given year, we get taxed on. Now, I want you to remember that tax point here for a second. Tax deferred, and these are probably very familiar to you, IRAs and 401ks or 403bs. I want to stay with those for just a second. These are what are considered qualified plans. And what the ERISA and the government has said is that if you put money into these, you can actually put them in pre-tax. That means that you're not taxed on the dollars going in. More dollars go into them. And while they're in these qualified plans, that money can grow tax deferred. And that's wonderful because when we talk about the ability for money to compound, and this was part of a discussion that Keith brought up, it's very valuable to us. And not having the IRS digging into our pockets and taking that money out in any given year or each year, that means there's more money there to compound for us. Now, in those two, it goes in pre-tax, it earns every year. There's no tax based on any interest, dividends, or capital gains that are earned inside those accounts until the point at which you take it out in retirement. Now, there's some rules around this, like for instance, you can't access these. So there's a little bit of a restriction. They're not as liquid. If you take your money out before, if it's 9.5, there's a 10% penalty on that money. You're taxed on everything that comes out. And more importantly, when you take the money out of it, every dollar that comes out of this is 100% taxable, whatever your current tax rate is. Now, there is another tax-deferred vehicle that is available in this category, and these are annuities, and they've been around a long time, and some of you may be very familiar with those. But in essence, the dollars that go into these, if they're not embedded in one of these particular qualified plans, they go in after tax. And as the money builds up in there, the interest, the dividends, and the capital gains, again, you have that compounding effect without the IRS taking those dollars out. So all those dollars keep building on itself, which improves that return. When you take it out, a portion of that money is going to be taxable. You have to pay that IRS bill at some point. There's a debt you build up inside there. But a part of that money, when you take it out, may well be part of your principal. So you can control part of that at that time when you get into retirement. The last bucket is the tax-free bucket. And that tax-free bucket, there's really basically three places that allow you to get tax-free income. One of them is municipal bonds. Those of you that live in states like Pennsylvania, New Jersey, New York, and whatever, you have income taxes for the states up there. And as a result of that, in order for it to be tax-free income up there, those bonds have to be issued within those jurisdictions. For us in Florida, we don't have an income tax, so municipal bonds are one of the few places you can receive tax-free income. Now, if you do buy a municipal bond and you have the good fortune of buying it cheap and selling it a little bit higher, there's a capital gain. Capital gains are not tax-free with municipal bonds. So it's that financial literacy thing, giving you a little backdrop on it. There are two other sources that you can go to get tax-free income when you're in retirement. One of them is called a Roth. That can either be a Roth IRA, or many 401k plans have a Roth alternative within them that you can put money into. So how does this work? In a Roth, the money goes in after you've paid taxes on it in that year, but then that money, just like in the IRA and the 401k, accrues or grows without any tax liability. You don't have to pay tax on it. So it compounds, and it's that taxes, but in this case, they're not deferred. The beauty of the Roth is that when you take that money out, it's completely tax-free. All right, why is that important? Because in the environment that we're in today, we need to determine what is our tax going to look like when we get into retirement, and having the ability to take income out at that point tax-free can be very, very valuable and beneficial. And there's one third category, and that's insurance. There's certain types of insurance that allow for you to not only get your death benefit for your heirs should you die, earlier than you'd like to, and I think we'd all like to live longer, but there's a tax-free benefit that can be passed on to our beneficiaries. But many of these policies have the ability to provide internal growth within them, and interestingly enough, totally without tax. And if you wish to take money out of what is developed or what's grown in terms of what's called a cash value, you can actually take that out of the policy in the form of a loan, and that's tax-free. So they can be a source of tax-free income. But those are the only three areas where you have the ability. Now, the reason I bring this up is it's not to say that any one of these is better than the other. As a matter of fact, it's quite the contrary. The question is, as we look at our retirement and what we want that to look like and what we think our situation might be in retirement, the question is how do we use each one of these to be able to provide us for the retirement that we want so that we don't have to worry about it when we get there. Building block is wherever you are right now, one of the things that's extremely important is how well have you prepared for retirement? I think it was Confucius. He was asked the question is, when's the best time to plant a shade tree. Some of you may have heard this one. What was his answer? 20 years ago. But the second best time is today. It's absolutely true for retirement. The earlier we start saving for our retirement, the better off it is, and the better prepared we will be when we enter into retirement. What this is in front of you is a chart from Fidelity, and Fidelity provided some rules of thumb. And all of us should, as early as possible, take a look at where are we in being able to prepare for our retirement. And this is very straightforward. It says that if you're at the age of 30, you should have one times your income saved for retirement at that point. Now, remember I said retirement doesn't mean money that's invested in other areas to build your wealth. This is just to protect your retirement. And as you get older, that number obviously goes up, and to the point where, and they've identified 67 as the retirement age here, and they say that the rule of thumb is you should have somewhere near 10 times your retirement saved, or 10 times your income at that point saved to be able to sustain you in retirement. And this is great. It's a good way for you, when you step back and you look at your savings, is to how you doing for your retirement. But bear in mind that we're all different. We all have different visions of what our retirement looks like, what our expenses might be. And although this is a good rule of thumb, recognize that we have to really adapt where we are today and align that to where we really want to be when we retire. And there's a couple other factors that we want to take into consideration here. And let's talk about our savings. One of the best places to put our money is perhaps in the markets. All right. Do you think the markets are going to be a little bit volatile going forward from here? Just to shake your heads, anybody think it's going to be a little bit crazy? Yeah, it sure is. It's going to be a bumpy ride. Well, when we're talking about our retirement savings, part of what we need to do is we need to make sure that the level of volatility that we will see, and it is going to come, and it's going to come through the elections, it's going to carry into next year. Matter of fact, the markets have always gone up and down. But we need to make sure that that is aligned with how much risk we can actually take during our accumulation years. And of course, when we get into retirement, it's a whole different issue because we shift from accumulation to income at that point. So this is nothing more than a point of reference to say when we save for retirement, there is no one solution that works. It needs to be a combination of those options that were in front of you. It can be investments, it can be insurance, it can be real estate. There are other investment and saving solutions like CDs, guaranteed choices that we should be looking at. The question for each of us is individually, those have to be designed specifically for you and your circumstances. I think Keith made a good point in his presentation 2 weeks ago, and he said, we need to be able to manage this volatility. And anybody remember what he said was the key to that? Anybody want to just unmute and speak up? Remember? It's diversification.
Plan.
It's diversification. And how we diversify and how we allocate a bunch across the different options that are available today is going to be absolutely critical to creating a level of certainty that we can retire when we want, the way that we want. All right, what are we saving for? Well, here's some interesting stats, and this is really important for all of us to think about as we save, and the importance of saving now and making sure that those savings and those investments are aligned to one very important thing. We're all living longer. Hey, the good news is, and this is great news, we have better lifestyles, healthcare is much better, and that means that we are able to have those years in retirement. As a matter of fact, this is a mortality table that says that once you reach the age of 65, there's a 50% probability, by the way, 50% won't make it and 50% will go past it, that we're going to make it to our late 80s, get close to 90 years of age. There's another 50% chance that we're going to live to our mid to late 90s, and then a number of us are going to make it into 100 years of age. Well, what that says is, and this is one of those key interesting points as we plan for retirement, we work for 30, 35 years. The last thing in the world we want to do is have to worry about those 35 plus years that we'll be in retirement. By the way, I've heard retirement described as being unemployed because our savings have to sustain us during that period of time. How many of you have heard of the rule of 72? There we go. Rule of 72. Yeah, I think, Chris, you better raise that hand. I was just going to say. The rule of 72 was used, and it's one of those rule of thumbs again that says that if you take a specific rate of return and you divide it into 72, and if you're able to maintain that rate of return, that will tell you how long it takes for your money to double. Well, it's also used in retirement planning as a way to determine how our expense is going to act. And it's the same thing. And if we take what the average rate of inflation has been over the last 100 years, which is around 3%, and we divide that into 72, that means that there's a pretty good chance that our expenses might double in the next 24 years. Folks, that's well within this lifespan that we all have ahead of us. So not only do we have the investing leading up to retirement, but we have the investing and the saving that we do once we move into retirement as well. So all of these are factors that have to be built into our retirement plans. And I'm going to come back to that in a second. So I want you to hold on for me, and you'll see why when we talk about those 5 rules, why number 1 is where it is. But there's one other factor. Getting older has created another challenge for all of us. There's another expense we have to prepare for. And by the way, I don't mean to be gloom and doom here, guys. It's not, because there's solutions for every single one of these things if we plan in advance for them. But here's the second one. Once we reach the age of 65, the statistics tell us that there's a 70% chance that we're going to need to avail ourselves of formal long-term care. That's right. At some point during those retirement years, we will require that. Now, what does that mean? If we think about what assisted living costs a day on average, just assisted living now, and for many of you may have had to work with your parents or friends and help them go through this period. That cost right now is around $40,000 a year. It's not, those expenses are not fully covered by things like Medicare and some of the Advantage plans that exist out there. Those are expenses that we will have to pay out of our savings. And the average length of time that people spend right now, and this is today, is about 4.3 years. Remember, those numbers that I gave you are today's numbers. Those costs are going to go up just like inflation will go up. Now, what's the solution to this? Well, there are a number of them that potentially exist. One of them is long-term care insurance, which is something that everybody ought to take a look at. Remember, I talked to you about those the tax-free income option that existed through other types of insurance. Well, insurance has evolved over the years. It's become less expensive to us that look at it, but they also have it. Not only can they provide that death benefit that's tax-free to the beneficiaries and can provide potentially tax-free income, many of them have riders that are attached to them, and you got to pay for them. That also helps to offset long-term care costs. So there are solutions that can be built in to help us deal with this. Now, by the way, this 4 to 8 years, if we're unfortunate enough and if they don't find a cure for it, which I hope they do, if we have dementia or Alzheimer's, that can be extended to up to 8 years that we might be in long-term care. So what has all of this done? This brings me to my 5 rules. And they're really critical because number 1 really says you need to have a plan for all of these things that can affect us while we're in retirement. We need to be able to sit down and analyze where we are today, how much we can save, envision what our retirement might look like, and try and take a look into the future and plan for what that is. Now, the interesting thing about retirement plans, and unfortunately, less than 20% of the folks that we meet with actually have a retirement plan. But the most important part about having a retirement plan, and those that do, is they don't revisit them. These need to be revisited on a regular basis, like at least once a year. Why? Because things change, kind of like no one expected to see the year that we're in this year. And that can have an impact and effect on people's retirement savings and their plans. Life events can take place. Tax laws can change. There's all sorts of things that can affect people's ability to retire the way that they want in the future. So the retirement plan is the foundation. Get one in place as soon as you possibly can, and then constantly update that on an annual basis. And number 2, got to know what your risk is. Again, Keith hit on this when he was talking about risk profiles. And there's two things. There's a thing called risk tolerance, and there's a thing called risk capacity. Both of these need to be factored in. Risk tolerance is our emotional ability to deal with investing and saving today in the markets. This is a gentleman by the name of Peter Lynch. He was the manager of the Magellan Fund, perhaps the most successful fund that Fidelity had years ago, and he wrote a book. And in his book, what he said was that he was very concerned, and he was very sorry about the fact that most of the investors in his fund never achieved the rates of return that the fund did. And he was very clear. And what happened was people had a tendency to react emotionally to the markets and what was going on in the fund. When the market went up, people wanted to invest. When the markets went down, they were scared and they decided that it was time to be more safe. Well, that's just the opposite of the way it's supposed to work. So knowing what that emotional quotient is very important. What is the tolerance that you have for the market? So when you diversify, for instance, your investment portfolio, it has to be aligned to that tolerance for risk. Now, the other one is risk capacity. Risk capacity is a calculation. It determines how much you need to earn over what period of time, and what is the most appropriate, reasonable rate of return for you to get there. And that will give you an idea of what your capacity is based on your current investments and savings. Number 3, and this is the one that gets violated from time to time, and that is that a retirement plan is a sacred account as far as I'm concerned. And the reason that I say that is because that has to provide for something that is very, very long term. Your needs that your retirement savings and investments have to provide for are way down the road. As we talked about with longevity, we're talking 30, 40, 50 years down the road. So that money has to be looked at and preserved to be able to do that. Unfortunately, from time to time, we see people dipping into their retirement accounts and saying that they're going to maybe buy a stock because they think it has a great opportunity. This is not where you speculate. When you allocate your wealth, your investments and your savings, part of it needs to go into retirement. The other part you can use to build your wealth and to make those speculative. I mean, there's money there that you put aside for Robinhood if you want, if you like that concept. And if you want to speculate, go for it. But that has to be part of, guess what? Rule number 1, your plan. Discipline's absolutely critical. It's times like we're in today, things that none of us ever predicted, when it can be real easy to get away from our discipline and saving for our retirement. As a matter of fact, there are times like these when we may have to actually go into our retirement savings just to meet our basic financial needs. Well, we need to know where we are, and we need to make sure that we absolutely stay on track. And if we have to do that, we have to have the discipline to find out the most appropriate way to get back on track and to put these savings in place so that we can retire the way that we want. And you might expect that number 5 on this list, with everything that I've talked to you about, we know that planning and saving for retirement is not necessarily the easiest thing in the world to do. And from this perspective, it's great to seek advice. Now, a couple of quick things. There are resources that exist out there. And when I talked about how much you should save for retirement, how much you should have saved for retirement, and some basic retirement planning that you can do, I have put in the chat box a link to our website, and we have a resource section. It's like a financial library. We have all sorts of information out there that ranges from estate planning, insurance, investments. I mean, there's all sorts of available resources. And if you would look under the retirement tab there, once you go into resources, you will find some calculators. This is free. This is not something that you have to pay for, nor are we going to bug you if you go in there. We're not going to follow up with these annoying, hey, by the way, I noticed you were in my website and wanted to follow up with you. We're not going to do that. It's there for your use, and please avail yourself of it. More importantly, seek that advice. It's important for all of you to make sure that you feel comfortable and you don't end up like that couple I met with last week. Hey, Arif, it's about thriving, not just surviving, correct? So,
100%.
Yep. So, folks, I don't know. We've got maybe 1 or 2 minutes. I'm happy to continue this next week as we have done in the past with any questions that you might have. By the way, Linda, if you go to that resource site, you will find a third-party paper written on how to choose an advisor. Wasn't written by me. It was written by a third-party source, and it can give you some good insights as the types of questions that you want to ask and how to choose the one that is best suited for you. Again, it's a very personal choice, so please feel free to access that.